Picture two envelopes. Both cost you $1,000 today. Open the first one in a year and you'll always find $1,250 inside. Guaranteed. Open the second and you might find $1,300. Or you might find $800. You don't know until you open it. Which one do you pick? That question, right there, is the entire idea behind risk and return. And once you understand it, you'll never look at a stock chart, a savings account, or even your own decisions the same way again. Let's start with the guaranteed envelope. That's low risk. The outcome barely moves. A savings account, a government bond. These live here. You sleep easily, but you don't grow much either. Now the second envelope. That's higher risk. The outcome swings. Sometimes up, sometimes down. Stocks, startups, crypto. This is their neighborhood. The swings themselves have a name. Volatility. The bigger the possible swing in either direction, the more volatile something is. Here's the part most people miss. Risk isn't the price you pay for return. Risk is the return for taking on uncertainty. Markets don't reward you for holding money. They reward you for tolerating the swing. This trade-off has a name: the risk-return trade-off. Higher potential return almost always demands higher potential risk. And no serious asset lets you skip that rule. If someone offers you high return with zero risk, that's not a discovery. That's a red flag. Let's put real numbers on it. Say you invest $1,000 for 1 year in two places. Place 1, a government bond paying 4%. After 1 year, you have $1,040 every year. No surprises. Place 2, a stock index. On average, it also tends to return around 4%, but average is hiding the real story. In a strong year, that same $1,000 might become $1,300. In a weak year, it might drop to $800. Same starting point, same rough average over time, wildly different single-year outcomes. So why would anyone choose the stock? Because over many years, the swings tend to smooth out, and the higher potential return compounds, remember compounding from last lesson? Into a bigger number than the safe path ever reaches. The bond guarantees comfort. The stock offers growth in exchange for tolerating the ride. This is why a 22-year-old and a 62-year-old are given very different advice. The 22-year-old has decades to ride out the swings, so more risk makes sense. The 62-year-old has less time to recover from a bad year, so safety starts to matter more than growth. There's no universally correct amount of risk. There's only the right amount of risk for your timeline and your ability to stay calm when the number drops. One more thing to sit with. Risk isn't something you eliminate. It's something you manage. By spreading it out, by matching it to your timeline, by never needing all your money on the same day the market has a bad one. So here's the one sentence to keep. Return is the reward for uncertainty. And how much uncertainty you can hold is a decision, not a guess. Next lesson, we take this idea one step further. How spreading your money across different places can lower your risk without lowering your return. That's called diversification, and it's the closest thing finance has to a free lunch.